Okay, we are going to take a look at the Survivorship whole life insurance product. So a Survivorship policy has some pros and cons, as we touched on briefly in our overview video. So what a Survivorship policy is, let's start with that, because this is not as commonly covered as much as all of the other whole life insurance products. A Survivorship life insurance policy is one policy on two individuals. Typically a husband and wife. Some corporations use them as well on different business partners. Really, what a survivorship product does, the pros and cons to it, let's start there, is because the product is on two individuals, one policy on me and my wife, for example, the death benefit does not pay out until both individuals die. Meaning if I die, my wife does not receive the death benefit proceeds. She still has access to the cash value, but she does not have access to the death benefit. When both individuals die, the death benefit's paid out. So if there's any need for life insurance, the actual death benefit proceeds to go to the surviving spouse, or if it's a business partner, however it's structured, this might not be the way to go. So that's the disadvantage. The advantage is because both people have to die before the death benefit's actually paid out. The insurance company knows that there is a good chance they're going to hold on to that death benefit claim for a longer period of time, because both people have to die first. Statistically, one individual is more likely to die sooner than the other. As a result of them holding on to the death benefit claim for a longer period of time, you'll find that the internal insurance expenses are lower and the cash values are greater than what they would be in a single life policy. We're going to quickly compare to a traditional whole life insurance policy as well, so we can see it as opposed to just hearing it. So let's go through the basics here first, like we did with other products. If I'm paying in $1,000 per year toward the base premium and the PUA component, again, understanding the relationship of these dollars, how does my money actually work? What you'll find is in the first and second year, very similar to that of a traditional whole life insurance policy, zero, a very small percentage, I should say, shows up in cash value. And you'll see a percentage starts coming back the third year, but it's not 100%. It's nothing like a traditional. It starts to come back year 3, but it's really not until year 4, 5, so on and so on. The early years in respect to the base premium are not that attractive at all with a survivorship policy. And again, the reason why is that the insurance company is going to overcharge me for the death benefit up front. Now, most examples, we write $50,000 there if I'm paying $1,000 base premium in. Here we wrote $100,000, and the reason why is, again, this is one policy on two individuals. The insurance company knows that they do not pay out a claim until both individuals die. As a result, that death benefit, I should say the premium we have on the life insurance policy, is naturally going to purchase us more whole life insurance death benefit. You will notice that. So it'll get you more death benefit. The PUA component will function very similar. When I say similar to what it would do in a traditional policy or any of the examples, I see it in cash value, I can access that, begins to compound for me, and does buy me some death benefit as well. And again, because it's a survivorship policy on two individuals, this is what the mortality tables are based off of, two individuals, not just one. Those PUA payments are going to buy me more paid up life insurance as well. Good to be aware of that. Now, before we get into the numbers and look at an example here, if cash value is our goal, or we have a lot of interest in that, we're saying, okay, Steve, my goal is to maximize the cash value. Survivorship policies are often used for legacy planning. Great way to leave a large inheritance, second to die, meaning after both individuals die, passed on to the next generation. A lot of families and corporations use survivorship policies for this reason. However, where the cash value planning comes into play is specifically with this guy. Now, this is going to be a little bit more technical than what you're used to. When it comes to the MEC laws, the Modified Endowment Contract, what's another name for the MEC limit? The 7-pay test. the first 7 years of a life insurance policy. Call it the vice grips are very tight on a life insurance policy. If I reduce the death benefit during the first 7 years, I'll trigger a MEC. If it's after year 7, a lot of times I can cut the term rider, reduce the death benefit, and not trigger a MEC. With a survivorship policy, that cannot be done. The MEC treatment is much different on a survivorship policy than what it is on a single life policy. The MEC limit's the same. You're going to see an example where we set it at 50K, just like what we did with the traditional example, and most of all of them for that matter. But we will not be able to reduce that to the same degree as what we could with a single life policy. So let's take a look at some numbers here. Let's have some fun. So here we have a survivorship whole life policy. And again, what I want to understand here really is the base premium component. How does that impact my cash value? Because I can blend a policy for maximum cash value, which is great. We're going to show you exactly how to do that. But if my goal is optimizing cash, if I'm interested in that, well, understanding the relationship of where my money's going and how to juice that short-term, long-term, see the different options up front. We've just got opposite ends of the spectrum here. If you want to look at other options, you can certainly do that as well. But let's take a look here. So we have a 100% base premium. Actually, I should say, so we've got a 35-year-old male. This is a 35-year-old male and a 35-year-old female. So we just made them the same age. Why we did that specifically is when we look at the traditional policy, that's based off of a 35-year-old male. So you can see a direct comparison. But all base premium, $50,000 per year going in. There's your cash value right off the bat. Very, very small percentage in years 1 and 2. Some comes back beginning year 3, but not to the same degree that we see on a traditional product. Year 4, 5, now it's starting to pick up the pace. But like a basic old school whole life insurance policy, year 13 with an all base premium design is when we break even, just about. We've paid in $650, we've got $649 in this example. Based off the present dividend as well, guarantees are extended on the break even point. Then we've got a max blend with term riders, with a term rider, so you can attach term riders, often level and 1-year term riders to survivorship policies. And same thing here. So this is a company that allows us to go as low as 10% with their whole life products. When I say 10%, 10% of my total input, the 1090 split, call it, of the 50, 5,000 going there. A little bit towards a term rider, and the rest in the PUAs. Break even, year 5. Look at the cash value difference too. So you've got the same company, same product, everything's the same here as far as the individual, age, insured, all that good stuff, out of pocket, yet drastically different cash values. $133,000, same out of pocket for a consumer. This is the kind of stuff that we want to see up front. This way we don't have buyer's remorse after the fact. Let's see as time passes here. Funded it through year 30, $3 million, $3.2 million. Big difference there. Now, before we go further, I should say before we conclude, let's look at this. Year 15, at age 50, you got $828,000 on the all base premium policy, $828,000. Let's do this actually. You'll see where I'm going here. 15, $828K, survivorship. Year 15, $1 million, $31,000. Survivorship. Okay. Now what I really am interested in here is the single life policy. We ran the single life policy with the same company that we ran the survivorship policy with. Year 15, what do we got? On the survivorship, you had $828, excuse me. Here you've got 816. On the blended example, 1,009,000, you had 1,031,000. Same out of pocket. 15 years, you're starting to see it pull away, and that gap will get larger and larger as time passes. It's good to be aware of that. All right, so here, without writing it down, year 30, 2.865, 3063, single life, 2.865. Same point in time, you've got 3,050,000, close to $150,000 more, exact same company health rating, just on 2 lives instead of 1. Now you can argue, hey, I've got the death benefit in the single life policy, which is true. If that's important, or if we're not insured already, a single life policy may very well likely be the way to go. Over here, we have 3 million and change on the single life. Now you've got 3.2 million. So this is the kind of stuff, as far as seeing options, that I want to see before starting a policy, if I'm interested in a survivorship policy or different blend, whatever it might be. It's just seeing it up front. Not to say one option is better than the other or anything like that. Again, the more we know, the better, or the more informed decision we can make. So, know we covered a lot of information in this video and the others. Hope you enjoyed it. If you have questions or would like to see any personalized samples, reach out anytime. And we'll talk to you soon. Have a great day. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.